See, so let's just quickly revise. Um, let's say, acha, how will you articulate forward? Forward means what? Forward means, uh, so it is it is,
So
it
you
is
have
an
to
over
check
the
the
counter.
screen.
Oh, so forward is what? Forward is an over the counter derivative contract. Forward is an over the counter derivative contract to, okay, buy or sell the underlying. Why am I saying buy or sell? Because for the buyer it is buy. He is entering into the forward contract. Even the seller is entering into the forward contract. Okay, so it is an over the counter derivative to buy or sell the underlying, buy or sell the underlying asset at the future date for the price agreed today. Fine, that is forward. Then future also same way, but then exchange traded derivative contract. So it is an exchange traded derivative contract. Okay, to buy or sell the underlying asset at the future date for the price today. Okay, yeah, this is the one. Okay, this is future, forward futures. Then call option. Call option means it is an exchange traded derivative contract. Exchange traded derivative contract wherein the holder will get the right to buy, a right to buy the underlying asset. Wherein the holder will get the right to buy the underlying asset on or before expiry. Okay, at the strike price. Strike is also called exercise price. Okay, this is call option. Then put option. Acha, put option I have not spoken yet. Okay, right. So now let's do some some examples of call options and find out net profit and loss. So there is X, there is Y. So this is the holder. So what is holder's prediction? That the price will go up. Okay. 10 rupees is the premium. What is the break-even point now?
110.
Yeah, break-even point is 110. Okay, so break-even point is equal to strike plus premium. So 100 plus 10, 110. Now, uh, okay, what if the spot price on the day of expiry is 105? So tell me from the writer's perspective, what is the profit and loss?
₹5, right?
5 rupees. Profit or loss?
Uh, Loss.
Uh, 5 rupees loss.
Yes.
See,
Is it?
here, see, even if they ask about writer, you think from the holder's perspective. Holder is paid 10, but here he is going to get how much? Only 5.
Yeah, so 5 loss. So
So,
Yeah.
for
so
Y,
for
it
the,
will be profit.
yeah, so for the holder, he is getting 5 here, but he already paid 10. So it is minus 5 for him. If it is minus 5 for him, for the writer, it has to be the opposite. So it will be plus 5 for him. Okay, that means profit. Did you say plus 5 for the writer?
Yes, sir.
Acha, you said this only. Okay, okay. Yeah. Hmm. Okay. Hundred and one. Now, what is the profit and loss for the writer?
9 rupees profit for the right.
Hmm. Okay. So, 111. What is the profit and loss for the writer?
1 rupee loss.
1 rupee loss. Is it fine? Shravani, you understood?
Yes, sir.
100 is the spot price now.
So yeah, 10 rupees profit for the right. Right?
Yeah. 99.
Then to 10 rupees, right?
Yeah. Because the holder is not going to execute.
Yeah.
So, writer will get 10 rupees only. 10 rupees will be the loss for the writer, which will become the profit. 10 will be the loss for the holder, which will become the profit for the writer. Okay. Is it fine? Okay.
Yes, sir.
Okay. So that therefore I can write a statement that the maximum profit, maximum loss for the holder is what? Limited to the extent of premium. The maximum loss for the holder is limited to the extent of premium paid by the holder. Is limited to the extent of premium paid by him. Okay. Now, now imagine the price upside. There is no limit. If the price goes to 200, then what is the profit for the holder?
It's 90, right?
90. Yeah. So how much it will go up, there is no limit. So that's
Like
why,
unlimited profit.
yeah. So the maximum profit for the holder is unlimited. Okay.
Yes.
Now coming to put options. So put option means what? See, in call option, holder is bullish, writer is bearish. Holder has the right to buy. So if he wants, he will buy, otherwise not. Writer has the obligation to sell. Okay, writer has the obligation to sell. The writer has the obligation to sell. Hello.
Yes, sir.
Right, okay. Yeah. So here, holder thinks that the price will go up, writer thinks that the price will come down. Now further innovation happened. So further innovation, they thought, see, this guy is bearish and he's getting the obligation. They thought, what if he wants the right? So these people said they want the right to sell. They said in return they are ready to pay premium. Why should they? Why should this holder get the right to buy? You understood the story now, how it is moving. Now writers are, like, imagine they are protesting that they want the right to sell instead of obligation to sell. So this Y comes here left hand side, and he says, I want the right to sell. That means if I want, I will sell, otherwise I will not sell. And I am ready to pay premium for that. 5 rupees, I will pay premium. So in this case, because one has the right, only one will have the right, others will have the obligation to buy.
Buy.
Okay. Hmm. Ah. So here he thinks the price will come down. He thinks the price will go up.
It's like short selling.
Hello.
Yes, sir.
Yes.
Okay. So right to sell and obligation to buy. Let's say 100 is the strike price. So now, when will he sell? When the price is coming down. Amount is decided. He will sell at 100. So if the price comes down, he will sell at 100 and he will get profit. Like if the price comes down to 70, he will sell at 100 and he will get 30 profit, paid 5 premium. So net profit is 25. He will take away the net profit 25. Okay. Uh, yeah. Uh, okay. So now imagine if it is 92. So what will Mr. Y do? Will he sell or not? The spot price is 92 now.
Yeah, he'll sell
He
it.
will say.
He will sell for 92 and how much will he get the profit?
Mm, three
8
rupees.
rupees he will get the profit, 5 he has paid as premium. So net
Three.
net 3 will be his profit. That means writer, he is the writer now. Acha, the name, you have to remember. Whoever is holding the right, he is the holder. Okay, the other guy will be the writer.
So now I is the holder.
Yes, yes. Okay. So now, uh, yeah. Okay. So now let's say it is uh, 96. Now, how much will the writer get, or how much will he lose?
1 rupee.
Let's do for 94 first. 94.
1 rupee profit.
1 rupee profit for whom?
Why? The holder.
For the holder. 1 rupee profit. Okay, 1 rupee profit, because 6 rupees is the profit. He has paid 5 as premium, so 1 rupee is the net gain. Okay. Now what if it is 95?
PEP, right?
Huh. So 5 rupees is the profit for Y, but he paid 5 as premium, so no profit, no loss. So break even point. So how can I convert this into a formula? That 95 is the premium.
Strike price minus premium, right?
Yeah, strike minus premium. So strike minus premium. Strike is 100. Premium is uh, premium is 5. 95. Okay. So yeah, now coming to 96. Now tell me how much will the holder get and how much will the writer get?
For the holder, 1 rupee ka loss, and for the writer, 1 rupees ka profit.
Yeah, fine. Yeah. So for the holder, 4 rupees is the gain, but he paid 5. So 1 rupee is the loss. So for the writer, 1 rupee is the gain. Okay. If it is 99, then
Four
Loss of
rupees.
4 rupees.
4 rupees loss for the holder and gain for the writer. 100, then
5 rupees loss for the holder and gain for the writer.
yeah. Okay. 101.
₹6 loss
He
for
won't
holder.
execute it.
Yeah, he will not execute. See, at any point of time, he has the right to sell. If he executes, see what will happen. 100 rupees, he is selling it for uh, he is selling it for 100, whose price in the market has become 101. So already he is losing one. And then he has already paid 5 rupee more as premium. So 6 rupees will be his loss. So what will he do? He will not execute only and take 5 rupees loss. Is it okay? Understood? And
Yes, sir.
always see this arrow. The reason why I'm writing this arrow is so that you get the hint that the moment the price goes up, he will not be interested. The holder will not be interested to execute. If it is not going down, the holder will not be interested. He is not interested even in 100. That's why he will not execute. So his loss will be 5. So 101 also, he is not. So you see this arrow mark always. Fine, okay.
Yes.
Yes.
Yeah. So now how do we articulate put options? So put option, acha, and one more thing, uh, put option, Y gets the right to sell. He is called as the holder. He is also called as, okay, let me summarize all this. So, so there is X, there is Y. He believes the price will go up. He believes the price will come down. Okay. This is strike. Now this person is called as holder. This is call option I'm speaking about. Holder, writer. Also called long on call. Hello.
So
Yes,
this is
sir.
during call, right?
Huh?
Yeah.
Just 1 second. I'm not able to write.
So you're not audible.
Hello. So you're not audible.
Hello, can you?
Yeah, yes, sir, you're audible.
Okay. Okay. Right to sell, and here obligation to buy. Obligation to buy. Then here long on put, and here short on put. Okay. Okay. Now tell me who is the buyer here in put option?
Uh, the writer is the buyer.
He is the buyer, holder. This is where people get confused. Okay.
Holder is the buyer.
Yeah. So let's discuss that point then. So why do we say holder as the buyer? Because holder is only paying the premium. Correct? He is only paying the premium. Now the statement is, he is getting the right to sell. That means he is buying the right. That is the complete statement. Buying the right to sell. Okay, buying the right to sell. So they will give you question like this. In a put option, the buyer paid, or the buyer, what will be the profit and loss for the buyer? Then you will think about the seller here, this side, right hand side, and you will make mistakes. Okay. Okay. Is this fine? This is okay?
Yes.
Okay. Yeah. So I can
Sir,
say,
can you
uh,
explain long on call and short on call?
huh. So long on call means he is buying the right to buy. He is buying the right to buy. Buying the right to buy. So he's buying the right to buy because he's paying, correct? He's paying premium. Paying premium so that he gets the right to buy when he wants. Similarly, here holder is paying premium so that he gets the right to sell. He's buying the right to sell. He's buying the right to sell. Is it okay?
Yes, sir.
Okay. So this is in put options, people get confused, and that, see, wherever you find difficult, that's what they will target. Okay, so this is clear right now.
Yes.
Yes, sir.
Okay. Okay, so this is called put options we have done. So that means if we recollect the chart, derivatives, over the counter, exchange traded derivatives, forward we have done, uh, then swaps we have not done. Okay. Then futures we have spoken, options, and call and put options. Call and put option. Okay. Yeah. So forward, futures, options. So left out is swaps. Now let's focus on swaps now. So swaps is first one, credit default swaps, then interest rate swaps, currency swaps, then equity swaps. So let's see what is credit default swaps now. Credit default swaps is very similar to insurance. Okay, like what happens in an insurance, let's speak about. Like there is one person who, who is worried about his life, that what will happen to his family members if something happens to his life. So what will he do? He will enter into an agreement with an insurance company. Let's say that is LIC. So here LIC. So now he comes up with an agreement with LIC that, look, I will keep paying you premium. If something happens, to his life, they have to compensate the family members. That is compensation, right? So that is how he is insuring. Okay. Similarly, very similar. Now there is a fund manager or portfolio manager. Now, few years back, he bought one, bond, some risky bond. He bought it, thinking that nothing will happen. But now he's scared. Now he's scared that something might go wrong. This company might default. They may not pay. This company may not pay interest. Now he wants insurance. So what he will do is he will get in touch with the investment bank, and he will say, look, I will pay you premium in case if something happens to this bond. That means if the company, defaults, okay, then this investment bank has to compensate. Okay. This bond is called as reference obligation. Some terminologies you need to know here. Reference obligation. And the company which issued this bond is called as reference entity. A reference entity. Okay. And this fund manager which is taking protection by paying premium, he is called as protection buyer. Protection buyer.
Like someone else is issuing it, and the IB is securing
Yes, yes.
it.
Yeah.
Is
Yeah,
it?
just like over here. Somebody's life, LIC is securing, right? That way.
No.
And investment bank is called as protection seller. Okay, so this is called what? This is called credit default swaps. That means the credit default risk has been swapped. Like here, life risk has been swapped. Here, credit default risk of the bond has been swapped to the investment bank.
So this would be done in the case of high risky bonds, right?
Yeah, fund manager, if he is be thinking that the bond might default, then only he will go for it. Yeah. Okay. So credit default swaps means what? It is an agreement. It is, first of all, it is an over the counter derivative contract. Okay. It is an over the counter derivative contract. Okay. So credit default swaps is an over the counter derivative contract wherein protection buyer, okay, will keep paying premium, will keep paying premium, will keep paying premium to the protection seller. Where the protection buyer will keep paying premium to the protection seller. And in case if the credit event gets triggered, if the credit event, what is credit event, I'll let you know, gets triggered, and in case if the credit event gets triggered, uh, and in case if the credit event gets triggered, protection seller will compensate the protection buyer. Hmm. Understood this one?
Yes, sir.
Watch out. What is credit event? Credit event means what is agreed, what is covered in that contract. Like for example, health insurance. Imagine now what is covered into that health insurance. Maybe critical illness only is covered. Maybe uh, only or only if only critical illness, or maybe like many other diseases will be covered, right? Similarly here, examples of credit events are examples of credit events would be what? Like delay in interest payment, delay in interest payment, then restructuring of the company, restructuring, then or bankruptcy. Okay, is this fine now? Credit default swaps.
Yes, sir.
Okay, next is interest rate swaps. Now interest rate swaps, okay, now short example of interest rate swaps is X and Y. X says I will pay you fixed rate. Let's say I'll pay you fixed rate. I'll pay you fixed rate, and you give me floating rate. So this is called interest rate swaps. But that's a too short explanation. Let me just elaborate and try to tell you the background story so that you will get an idea exactly what is happening. Okay, even though you will get more conviction about how this business is working. Okay, see, but you will not get questions on all this, whatever I'm going to speak now. But then it is good to understand, and then on that basis, you will be able to think better. Okay, see, now imagine there is a company. Okay, now this company X is going to a bank to take loan, bank A and bank B. Bank A, I mean, sorry, not bank A and bank B, bank A only. And bank A is giving two types of loans. One is fixed rate, another one is floating rate. So fixed rate, bank said I will pay you, or I'm going to charge, let's say 7%. Floating is MRR. MRR means marginal reference rate. Have you heard about LIBOR rate, MRR like that before?
Yes. London Interbank.
Yeah. Shravani, have you heard?
Yes, sir.
Okay, you heard? Okay. Okay. If not, you should just, go to the Wikipedia and read about it. But still, from my side, I'll just give you the brief explanation. Market reference rate means what? Basically, it is the rate uh, at which international borrowing and lending is happening. Okay, so at that rate, they will give you. Okay, market reference rate (MRR). Okay, earlier it was LIBOR, London Interbank Offer Rate, but now it has been replaced with MRR, market reference rate. Hmm. So here, this company $1 million loan they wanted. Now this company's, assume this company's balance sheet is not so very good. So this company thinks that I should not go for floating. I should go for fixed, because then only I will know fixed how much cash will go out of my pocket, so that I can plan properly. So what is their aim? Aim is to go for what?
Fixed.
Fixed, right? Yeah. So aim is fixed. So aim is fixed. So ideally, if they take 1 million loan and pay 7%, it's normal. It's a loan. Where is interest rate swaps? Nowhere it is interest rate swaps. However, now what they do, the aim is to go for fixed, but they are going for floating. So let's see how the game begins now. See, they are going for floating. So now what will they do? They will get in touch with the Innovation Bank, and they will say, look, so that aim, what they wanted, that they will do with the Innovation Bank now. See, they will say, I am going to give you fixed rate of, let's say, this is 7. So they will keep it lower than that, something 6%. And you have to pay me MRR. Okay, now let's see how it works. Cash outflow and cash inflow. Let's see. Cash inflow will be MRR, correct? So this is MRR. They are getting MRR. Cash outflow will be what? Outflow will be, here they are paying fixed 6%. Also they are paying here as well, no? Floating. Floating means what? MRR. That means this inflow and outflow of MRR gets cancelled. So net, what is the exposure? 6%.
So I didn't get this.
Oh, not understood. See. Okay. So I'll explain it again. See. Their aim is to go for fixed, but they are going for floating. Okay. They are going for floating. So, um, so now, but the aim is not fulfilled over here. So what to do to fulfill the aim? Now it looks like they have taken wrong decision. So, but this is not what they wanted to do, right? They didn't want to pay MRR finally. They wanted exposure of fixed rate, right? So what will they do? They will enter into an agreement with the investment bank, and then they will say, I am ready to pay you 6% fixed, and you give me MRR. Now, why do they do this? Let's see. This way, for them, they will get cash inflow of MRR. Cash inflow will be MRR. Cash outflow will be what? Outflow will be uh, cash outflow. What are they paying? They are paying 6% here. They are paying fixed 6%. Also, they are paying here MRR. Is this fine till here?
Cash inflow is a loan amount, right?
Cash inflow,
Is a borrowed amount.
that is the interest rate swaps. So they have entered into interest rate swaps saying like, I will pay you fixed interest, you pay me floating MRR.
Okay.
So net, you see what is happening. Cash inflow is
And,
MRR and cash outflow is also MRR. Gets cancelled.
yeah,
Net, he is paying only 6%.
6%. So the company is paying 6% for the debt
And
they have taken.
yes, overall. Otherwise, if they would, and it is fixed. If they would have gone by the original plan, they would have paid how much? 7%.
Yeah,
So every time they are paying, saving 1% of 1 million, right?
yeah, 1%. Correct.
So this is actually interest rate swaps. But these are all the background ideas, background why they are entering into. Okay, which this story was not telling us. So I'm just giving you the background story why interest rate swaps will come into play.
So can you give us an example,
Example as in,
as in like say, taking a certain amount and then
acha, certain
yeah.
amount. Okay.
Mm.
So let's say, acha, okay. Then let me again explain by taking the amount. This is company X wants to take loan from your bank. Bank is offering two types of loan: fixed rate 7%, floating rate is MRR. Let's say that rate is, it will keep floating. We will give some numbers also. Okay. Now the aim here is, this is the aim, but they are going for floating. Now how it will work out is, because they wanted to pay fixed rate, they get in touch with the investment bank and then they are saying, I will pay you 6% fixed. And to pay MRR. Now assume the MRR is, let's say, 5%. If the MRR is 5%, then what will happen?
So the IB is benefiting by 1%, right? That's how
Uh,
they are.
wait, yeah, 5%, right? Wait. Cash outflow. Uh, I'll write cash inflow first. Cash inflow is equal to uh, cash inflow is MRR. Now let's say this MRR is 5%. That means 5%. And is equal to cash outflow is 6% we are paying here, fixed 6%. Also we are paying here MRR. MRR is 5% we have taken, right? So this 5 and 5 gets cancelled. 5 will come in, 5 will go out. Cash inflow, right? Inflow is 5. And this is cash outflow. So this is not a worry. Let's say instead of 5, if it is 8, doesn't matter. You will get 8, you will pay 8. If it is 10, doesn't matter. You will get 10, you will pay 10. So you are not worried about the MRR. Finally, you are going to pay only 6% fixed rate. Is it okay?
But so isn't like, so let's say if the company is paying the IB 6% for the amount and the IB is paying 5%.
Huh?
Like,
Sorry, say it again.
so the company is paying 6% to the IB, and the IB is paying 5% to the company, the bank. Like, is
Wait.
this how
Company is paying 6% to the
IB?
IB. Yeah, IB, 6% to the
And
IB.
then
Yeah.
IB is paying the market MRR to the company.
Yeah. So which will keep changing every year, right?
Okay.
So they are taking that risk and then they are paying that amount. So if that amount is 5%, they will take 5 and they will pay that to the bank over here 5.
So IB will pay to the bank, right? And not the company.
No, IB will pay to the company. Company will pay to the bank, no?
Okay. So like what is the like what is happening over here? As in,
Uh,
what is the actual activity here?
See, actual activity is, if you would have simply taken bank loan,
Uh,
you would have paid 7%.
okay.
Now, after all this circus, you are paying only 6%. You are not worried about MRR, because whatever MRR you will get it from the investment bank. That you will pay to the bank. So every time you are saving 1%, right?
Yes. But then what is the IB getting?
Okay, fine. So are you convinced that every time company X is getting 1%?
Yeah, like I got that. But then what is I was confused about this one.
Okay, fine. Then I have to further elaborate the story
Okay.
to know what is IB getting here. Okay. So, okay, then because you asked, I have to further, I'll elaborate. So, what we have understood now is why company X is doing interest rate swaps, right? That much
Yeah.
should be fine. So, cash inflow will be MRR, cash outflow is fixed rate plus MRR. Now just think another company is there, company Y. This company, acha, by the way, in this contract, there is no. First, I will answer your query. Company Y also wants $1 million loan, from any other bank. So this is bank A, this is bank B. Now this bank is also offering, okay, two types of rate. One is fixed rate, one is floating. Fixed and floating. Fixed is, let's say this is a creditworthy bank. So company B, bank B says fixed 5% or MRR you have to pay. Either 5 or MRR you decide. Now company, because it is a good creditworthy company, balance sheet is very good. Okay. So so now they want to take risk with floating. That means their aim is floating, because and also their research team must have told them that MRR will come down in the market. So what is the aim here? Aim is to go for floating. So ideally they should have taken this loan from the bank and they should have paid MRR, but they are not doing. What are they doing? They are going for fixed. Now let's see how it will work. Is the story, this part is clear now? Right side?
Even company Y is paying fixed. Right?
No. See here. Company Y is paying floating now. Aim is
Okay.
floating.
Aim is floating.
And here it was opposite. Aim was fixed.
So like you wrote going for fixed.
Going for fixed. Their aim is floating, right? They
Okay.
want floating only, but they are going for fixed. Okay. Then, so their aim is fixed. Their aim is floating. So that aim they will actually fulfill with the investment bank. So now they are going to the investment bank and then they are saying, I will pay you MRR, because that's what they wanted.
Yeah.
Okay, you give me 5.5 fixed. So now let's see what is the cash inflow and outflow. Cash outflow will be what? Or cash inflow will be 5% fixed.
5.5 you said.
5.5, sorry. 5.5. Fixed rate 5.5. Okay, that is the cash inflow. Cash outflow will be what? MRR
MRR plus fixed.
plus fixed rate of 5%. That is 5.
So now your fixed
And
and fixed gets
it's
cancelled.
cancelled. So whatever be the MRR, if it is
So
7,
here
they
again
will.
it would be 5.5, right? MRR plus fixed.
Acha,
Or is it
acha,
five?
sorry. Yeah. It will not fully get cancelled. Okay. So here, it will not fully get cancelled. So here, you see, he is going to pay. See here, uh, he is receiving zero point 0.5 extra cash
Yes.
inflow,
Right. Right.
0.5 percentage extra inflow,
Hmm.
and he is paying MRR. Now,
Yeah.
it was
So
his
it's
intention to
6.5.
pay. It was his intention to pay MRR, whatever be the MRR. If it is 8, he will pay it. If it is 5, he will pay 5, because he was ready to take that exposure.
Yeah.
But every time he is also getting zero point 0.5 extra, right?
Right.
So that is the gain for him now.
Yeah.
Now you tell me, why would investment bank enter into all this?
So, so sir, like firstly here,
Hmm.
so suppose like if the MRR is 8% right now, so company Y is paying 7.5, right? Because they're gaining 0.5%
Yes, correct.
to the bank.
Yeah.
And IB, so IB is paying 5% of MRR and mm,
Hmm. See this. See how much is company Y paying? 7
yeah,
MRR. Whatever be the MRR.
yes,
That MRR investment bank will give it to the company.
yeah,
How much is the company paying? 6 percentage to the investment bank, and how much is the investment bank paying to company Y?
5.5,
So in between,
0.5.
0.5 is their profit, and they don't have any exposure to MRR.
Okay,
Another company is taking the exposure, right?
right.
Is it okay now?
Okay, so, so like here the amount should be same, right? Like the
$1
amount of
million,
loan.
$1 million.
Yeah, yeah.
Yes. Otherwise, partially you will do. Right. If the counterparty is not agreeing, you will do partially, and you will find out another investment bank to do for the remaining.
So like company X is paying 6% and IB is paying 5.5 to company Y. So here IB is gaining 0.5%. And again company Y is paying 7% to IB and then IB is paying again 5%. So here they're gaining 2%.
Hmm.
Is
No,
this
IB is gaining 2. Where is IB gaining 2?
mm,
IB is paying MRR, receiving MRR. So nothing they are gaining here. But
okay?
here IB is receiving 6 percentage, and they
Yeah.
are paying 5.5. So they are gaining
Yeah.
zero point 0.5 na, in between this
Yeah.
part.
Okay. And the down like
Down they are getting nothing. Whatever be the MRR, that only they are paying.
okay.
Right? If it is 7%, they will pay 7. If it is 5%, they will pay 5. Right?
Okay.
Is it okay?
Yes.
Okay. So that is interest rate swaps. And these kind of videos are already there, okay, in the YouTube. I have put across. So there also, if you type interest rate swaps, you will get it in my YouTube channel. You can watch that also. Okay. Shravan, you understood all this?
Yes, sir.
Okay. The next one is uh next one is, what is that next one? Currency swaps. So let's say currency swaps now. Acha, some other characteristics. Here you see, when they are entering into the interest rate agreement, interest rate swaps, uh, investment bank will pay 5.5 here percentage, but 5.5 percentage of what amount?
The borrowed amount.
of $1 million.
Yeah.
Yeah, but actually there is no exchange of the principal amount. Principal amount is exchanged only when they are taking loan from the bank,
Okay.
not between investment bank and the.
Only the interest, right?
Yeah, yeah. So that means in an interest rate swaps, principal is notional. So
Sir,
in an interest rate swaps,
but why would they even pay the principal and all?
notional principal is used. That means it is an assumed principal.
Yeah.
It is used only
Like
for
for the
calculation
calculation
purpose.
of interest, right?
Yeah. So actual principal is not exchanged. Okay. That's why it is called notional principal. Notional principal is used. Interest rate swaps uses notional principal. Okay. Hmm. Okay. Now, currency swaps. So they are swapping currencies now. See, imagine there is Microsoft in US and they want to come to India. So which currency do they require? They want to set up a subsidiary in India. So they require Indian currency. Assume they require 85 rupees to set up the business. And so they have to convert their dollar into rupee. So they will have to incur conversion cost.
Yes.
Okay. Similarly, imagine there is Reliance. Reliance wants to set up a business in US for which it requires $1 and the exchange rate is $1 is equal to 85 rupees. Assume like this. Okay.
So like here they are getting rid of the charges. Is it?
Yeah. Yeah. Let's see how it works. Uh, so now they both will have to incur conversion cost. So they are thinking Reliance already has, Reliance is thinking. Uh, Now, first of all, they don't have money. Neither Microsoft has any money, nor Reliance has any money. Okay, because normally they tend to borrow. So now imagine they have borrowed $1. So they issued bond. Through bond, they have got $1. Okay, now they have to convert and get 85. Reliance also issued bond, and they have got 85 rupees. Now they have to convert. Uh, so it's a 2-year bond. Assume like this. Both are 2-year bond. And they have to convert and they have to bring dollar. Now they are thinking that it will incur conversion cost. So what to do now? How to save that conversion cost? Because imagine it's a billions of dollar, billions of dollar. So even 0.5% is a big amount of this billion. How to save that money? Simple. It is just how we did in our school life, that you are good in English, I'm good in maths,
Those
so I
bonds.
will teach you maths, you teach me English, that way. So
So we'll
similarly,
exchange the bonds.
yeah, exactly. Not exactly the bonds, but then see here how it will work is, uh, but then that's what here currencies will be exchanged. So Reliance will say, look, I already have 85 rupees. So Microsoft, don't worry. When you come to, India, I will give you. So Reliance will say, this is Reliance, will say, I will give you 85 rupees and you give me dollar. So Both the requirements are fulfilled now, right? And you have saved the conversion cost. Is it okay?
Yes, sir.
Okay. But again, this is a very short story. I deliberately included bond in the story because so that you get complete idea. So what is that complete idea? See, now imagine it's a 2 year one. See how it will work is uh, Reliance has issued bond, na? So Reliance needs to pay every year in which currency?
Dollars.
No, INR, right? Reliance has issued bond in INR.
Yeah.
So Reliance has to pay in INR, but Reliance has come to US and earning dollar. Similarly, Microsoft has to pay in which currency?
Now,
Dollar. But
dollar.
they have come to India and they are earning in INR. Now what to do? Any idea?
Like when
Now
so they
again,
just
again
exchange
Reliance.
the amounts or
Yeah,
something, right?
exactly. Yeah, correct. Now Reliance will say, look, uh, I will pay your dollar because Reliance has dollar.
Yeah.
Reliance is earning in dollar. So Reliance will say, look, Microsoft, I will pay your interest
In the
in
US.
dollar. Yeah, in dollar.
Okay.
I will pay it to you and you pay further. Okay, I will pay. And you pay. Okay. Okay. So here Reliance says dollar now here interest in dollar. Okay. And this will be what? Rupee interest. Microsoft will pay. This step is okay. Then again next year it's a 2 year bond, right? So next year again Reliance will pay second year also. Microsoft dollar interest, and Microsoft will pay rupee interest 2 year over. Now what will happen? Now Microsoft has to pay back the principal dollar amount, but it is in India. Reliance has to pay the principal, okay, exactly 85 they have to pay back, right? uh, to the bondholders in India. So what to do now? So what will they do now? So here this entire part was about exchanging interest. Now again they will reverse what they did before. So Reliance will say, look, I have to pay back 85, but I gave you 85, right? Give back my 85, I'll pay. So Reliance will get back that 85 rupee. And what will Reliance do? Reliance will give back that $1. Okay, Microsoft. So if you notice, Reliance is taking dollar, giving dollar, $1, same amount. Microsoft is taking 85 rupees, giving 85 rupees. So it is like, it is like they are taking loan. You can think from that angle. They are taking loan from each other, and they are paying interest to each other, and at the end they are repaying the loans to each other. Okay. And no matter at the end whatever be the exchange rate, even if $1 is equal to 90 rupees, Microsoft is not going to pay 90 rupees now. It will pay only 85 only. Whatever was initially exchanged, only that amount will be exchanged at the end. That means in a currency swaps, currencies will be exchanged at the beginning as well as at the ending or at the time of expiry. That is one point. Another point is interest rate swaps can also be a part of currency swaps. Not necessarily that it has to be always, but it can be a part of currency swaps. So that's why I have made this example as a part of currency swaps. So interest rate swaps can be a part of currency swaps, can be a part of currency swaps. And in currency swaps, principal amount is exchanged. In currency swaps, principal amount is exchanged. Currency swaps, principal amount is exchanged. Is it okay now? Fine.
Yes, sir.
Yes.
Okay. Next one is equity swaps. That is easy comparatively. Equity swaps means there is X, there is Y. Imagine he is in India and he is in US. Now, if he wants to invest in Apple, he will be double taxed. One from America, then from India, all that thing. So he is entering into an agreement with Y. He says, look, similarly for Y, that problem will be there. If Y is investing in India, he will be double taxed, one from India and one from US. So they are saying, look, India, this guy says, look, I will give you the returns of Nifty. Okay. Because Y is interested in Nifty's return. And this X says, you give me the returns of S&P 500 or anything it can be. The rule is one leg of the cash flow should be based on equity or index. This is equity swaps. Equity swaps is also like Mr. X and Mr. Y. He says, I will give you Nifty's return.
So they'll have to hold the securities, right?
No, no. It is just based on the movement of the underlying assets, they will exchange the cash
But
flows.
then there'll be some counterparty risk as well, right?
Counterparty means here is the
As
counterparty. No,
in,
why?
like, what if they don't agree to pay? As in, let's say Nifty goes up and S&P like goes down. What will they do at that time?
What if the Nifty goes up? So one
And
party will profit, another party will lose money. So you are
yeah,
saying
so,
defaulting
yeah,
happens.
yeah, defaulting.
Ha. So now there is, one association called ISDA, International Swaps and Derivative Association. So ideally, they keep this as the umpire. That means they inform them, okay, and they follow the procedures of ISDA. So in case anything happens, they will chip in. So what we have learned initially is no initial margin and no third parties involved. But now actually ISDA comes into play. So why they are doing, so that there is no issues later stage.
Okay, so they are paying the returns, as in returns of the indexes, but uh, how will they decide on how much amount they'll pay to each other? As in, there should be certain
Whatever
number of
whatever the
shares, right?
returns, these are all returns. So imagine Nifty has given 12 percentage return,
Yeah,
and this is 10 percentage return. So netting will happen. Finally, 2 percentage will be given by the loser to the winner.
but then on how many shares? As in,
The principal amount will be agreed upon on $1 million.
okay. Okay. But that like
This
that is just
Nifty,
for calculating,
next
right?
just for
That $1
calculation.
million.
Yeah, yeah, yeah.
Uh,
Just for
the
calculation.
amount that is exchanged is the returns.
Oh, yeah, netting will happen, and then they will the
Okay.
loser will pay to the winner.
Okay.
Okay, so here imagine this is 5 fixed rate. You have to pay me fixed, I will pay you Nifty's return, or 8 and I will pay you Nifty's return. Even this is equity swaps only. The rule is at least one leg should be based on equity. Okay,
So the
or
second
imagine
one, one is fixed and the other is varying,
Nifty.
right?
Yeah, yeah, this is varying. So
So
here,
you're like Y is speculating and even X is speculating, isn't it?
yeah, they both, yeah. Now here X is I will give you Infosys return. Okay, and you pay me Apple's return. This is also equity swaps only. All these are equity swaps. So here the advantage is because before without investing all the money, they are getting exposure to the underlying asset. Okay, they are not investing all the amount, right? Still they are getting exposure to the underlying asset.
Uh, like they'll also have to fix upon a time, right? Isn't it? From
Yeah,
this time
yeah,
only
yeah.
they'll invest it.
So every
So is
quarterly
it
it will be
practical?
settled.
Like, is it
Every
happen?
huh?
Like, is it practical?
Yes, it happens highly. Yeah,
It happens.
yeah, it happens highly. Yeah. But then because it is happening over the counter, it is not published in newspapers.
Yeah, of course.
Okay. Okay.
So, like, one would have to open an account with ISDA to do equity
No, it is
swaps.
not necessary. But if you want safety,
Okay.
okay, if you want safety, then ideally all big players they are members of this ISDA, so they will inform them so that there is more transparency. Because what happens is these are all called off balance sheet liabilities.
Right.
Okay, so off balance sheet liability means you never know how much you will have to pay, right? Suddenly Infosys return zooms, imagine 20, 30, 40%. Now you have to pay that much. So that's why these are off balance sheet, and you are not aware that it will zoom for 50% up.
Yeah.
So that's why when it is all informed, what will happen? Mr. X has entered into the contract. Now tomorrow, if Mr. A has to enter into the contract with X, he will go to ISDA and find out what is his background. So he will know that X has already got exposure to all these things.
So
So
let's say
accordingly, he will play
if
safe.
Y defaults, then ISDA would make it up for uh, make it up for the amount.
No, no, no. ISDA, that means what is the punishment? What is the compensation? That will be clearly specified. And then accordingly, that will be taken from Y. So ISDA will make sure that the penalties are done without going to the court case.
Okay. But since there are no like margins and also like,
Huh.
like
There are no margin. No, now actually in ISDA, it is becoming more like futures only. Now in ISDA, when they go, they are supposed to keep some margin over there.
okay.
Okay. So it is more behaving like futures only. But the only thing is here still it is customized. Customized, right? They both can enter into for whatever time period, for whatever amount. From that angle, it is customized.
Right.
So what we have seen is forward, future options, and now swaps also we have seen.
Yes.
Fine, okay.
Yes.
Okay. So we will
Yes,
stop
sir.
now for today. And all these are there in my YouTube channel as well as here also I will record and I will send it to you. So whichever you want to watch again, you please watch it, okay? And then now you may attempt all equities questions and then next time we will discuss the doubts. We will finish off all the doubts of equities now.
Yeah. Yes.
Okay. And then we will come back to derivatives and finish it up, okay?
Yes.